We need to go to Japan. If your bros don't say this to you every other week, are they really your bros? Alright, maybe we can go to Japan, but before we go there, I need to do something everyone does before they travel abroad. Analyze the economic performance of the country based on various geopolitical factors and their consequences on financial returns. Okay, so let's go back in time to... Holy shit, Japan's about to conquer East Asia. China, the Philippines, Indonesia, and they may even conquer the Pacific Ocean. Forget about that. Japan was now occupied by the US, who had two main goals in mind with the occupation. First, make sure they don't have to drop another little boy in Japan, so they demilitarized the country and brought over freedom and democracy. Second, they wanted to assure a new ally in the Cold War. But after World War II, the Japanese economy was demolished. And when times are rough, communism is on the rise. So to prevent that, the US quickly begins to work on the Japanese economy with the Dodge Line, made by Joseph Dodge. The Japanese economy had two big problems. Inflation, which was solved by making loans difficult to get, making demand go down, and a shortage of industry. But remember how the US gave Japan two big gifts? Well, in the process they destroyed old, less efficient factories. So now Japan had the opportunity to build new ones, focused on more important industries. The yen was also pegged to the dollar at a fixed rate of 360 to 1, artificially making the yen weaker. Isn't that bad? No, it makes Japanese products cheaper and more competitive in the global markets. While the Dodge Plan did stabilize Japan's economy, it also made the Japanese jobless, but that changed when the Korean War began. The US intervened in South Korea's side, and they needed an arms dealer and a supply hub. And who was the closest ally nearby? Japan. So the US purchased $2 billion worth of Japanese military products, making the demand for industries like steel, textiles, machines and electronics go to the moon, while also solving the unemployment issue. The US also established new import trade routes to supply the Japanese industry, and to make sure they weren't getting guns from Wish.com, America shared its advanced technology with Japan. By the end of the Korean War in 1953, Japan was left with a great setup to jumpstart its economy, and that's exactly what happened next. The MITI, Ministry of International Trade and Industry, led by Hayato Ikeda, implemented some new policies. The new factories switched the focus from military products to industrial and commercial goods. We need to give capital to rising businesses, and to our advantage, everyone is putting more money in their savings accounts, so the banks have more money in them. Reduce loan interest rates, so businesses are more prone to raise capital. To make our domestic industries stronger, let's cut imports and focus on exporting to other countries. And remember the Zaibatsu, those business conglomerates akin to monopolies that the US dismantled for being racist and pro-military? Well, besides that, they were pretty cool for production efficiency, so bring them back, but less racist, I guess. These measures skyrocketed industrial production. Furthermore, in the 60s, Ikeda implemented the income doubling plan, which had the goal, like the name implies, of doubling the wage of the Japanese. What did you expect? Making people spend more money and boosting demand. These policies had tremendous success, and this is what we call the Japanese economic miracle, as Japan went from post-World War II economic chaos to averaging a 10% annual GDP growth in the 60s and becoming the world's third largest economy in the 70s. However, Japan's miracle was bound to end. The first signs of weakness in the Japanese economy appeared in the oil crisis of 1973. Basically, Japan was very dependent on oil for its industries to work. And who controls most of the world's oil? Middle Eastern Arab countries. And they had beef with Israel, who is backed up by the US. So the Organization of Arab Petroleum Exporting Countries stopped trading oil with the US and its allies. And that messed up Japan's flow. For the first time in years, Japan's GDP shrunk in 1974 by 1.2%. But then Japan adapted to its circumstances and developed more energy-efficient machines to power its industries, so everything ended well. This time. The next one didn't though. It all started on September 22nd, 1985, in the Plaza Hotel in New York, where diplomats representing the US, Japan, the UK, France and West Germany met. Basically, the US was losing money with trades with other countries, as the US dollar was too strong, which on the surface seems like a good thing, but it means that US products are more expensive and less competitive than others. So US businesses were taking a hit because they didn't sell that well internationally. To fix that, the countries that participated in the Plaza Accord decided to artificially make the dollar weaker and the other currencies more valuable. So the Japanese yen went from 242 yen per dollar in 1985 to 153 yen per dollar in 1986. And let me tell you, Japan suffered the most with this agreement. Japan has an export-driven economy, and all of a sudden, the yen gets more valuable and Japanese products are more expensive, resulting in Japan making less money. To try to fix that, Japan cut interest rates, which made borrowing money really easy, and that was the nail in the coffin. As money was easy to borrow, the Japanese stock markets were filled with liquidity, which resulted in the beginning of the Japanese asset price bubble. Shit, why is everything so expensive? That's a quick summary of what happened. In 1984, 1 square meter of land in the Tokyo commercial districts were priced at an average of 1.3 million yen. In 1989, that value rose to 30 million yen. What about the Nikkei 225? In 1986, it was barely above 13,000 points. By 1989, it was close to reaching the 39,000 point mark, reaching its peak on December 29th with 38,957 points. Prices are at an all-time high. We could almost say they are inflated, right? Inflation. That was the problem. And banks don't like that. So they raise interest rates a little bit and the market crashed. From 1990 to 1992, the stock market faced a 60% loss, ending up at as low as 16,000 points. The Japanese economic miracle truly was lost. After the asset price bubble burst, Japan entered a period in its history known as the Lost Decades, marked by economic recession and stagnation. After the bubble, Japanese banks had approximately $1 trillion in loans that the borrowers couldn't pay back. Japan was set on a deflation spiral and unemployment was at all-time highs. At first, the banks continued to lend money and the government was in denial, as they were the economic miracle guys. How could they fail? It was all temporary, right? Well, it wasn't, and eventually they had to act. By ejecting over 60 trillion yen into the economy, writing off the loans that couldn't be paid back so the banks could turn their focus back into investments, and killing off companies that were basically bankrupt but kept getting money from banks. These measures were able to stabilize the economy, but the economic stagnation remained. Enter Prime Minister Shinzo Abe, who tries to jumpstart Japan's economy once again by making the Bank of Japan buy a whole lot of financial assets to inject exorbitant amounts of money into the economy, coupled with low interest rates to make exports go up and spending money on public projects. He is able to get the ball rolling, but deflation is still going on. So in 2016, interest rates go negative, which means the banks pay you to borrow money. Then the COVID economic recession hit the world, and while every other country was battling against inflation, Japan had a golden opportunity to get out of the deflation spiral it was on for 3 decades. However, they still had to control the inflation. So in 2024, the Bank of Japan raises interest rates out of the negatives, but that made the yen a less valuable currency as it was more expensive to borrow. So Japan's economy took a hit and lost its 3rd place title to Germany. And here we are, in the big 2025. And what can we say about Japan? First of all, it still is the 4th largest economy in the world. We can't take that information out of the picture. However, the effects of the burst of the bubble can still be felt after 3 decades. Japan still holds a lot of public debt, amounting to 260% of its GDP, the highest rate of any developed country, and that takes away from Japan's ability to focus on investment. Japan also has a demographic problem in its hands. The people are getting older really fast, and the problem is, well, grannies can't work in factories. After the economic recession, the Japanese also still have some spending trauma. Coupled with stagnant wages, we get a population that doesn't spend as much as it is desired by the economy. And remember how Japan has an export-driven economy? Well, Trump wants to tariff everyone, and that would really mess with Japan. However, Japan still seems to have a bright future ahead. Having positive and currently increasing interest rates, plus the pause in deflation, is a good sign that Japan can recover and come back stronger. Also, the Nikkei 225 has reached the peak of the bubble without being in a bubble, so although the economy can be considered stagnant, it actually is slowly expanding. So, with all these factors in mind, am I going to Japan with the bros? Hell no, I'm not going to a country with an economy stuck to the past. I swear to God, the moment I place my feet on Japanese soil, the economy will crash again. I know I have bad luck like that. Huh? The Japanese yen being weak means everything is super very mega hyper cheap? Yeah, I know I've been saying that the whole video, but I didn't think I could use that in real life. Hold on, I'll call you later, bro. We're going to Japan, baby! Woo!